General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
All right, let's do the work. Today's Monday, June the 8th. The charts. Slow start to the day, no news drivers, no big narrative. After a large range day, expect chop, an old ICT proverb. So you got opened, tested, really a nothing day. Overnight session bounced off previous month. EQ inverted to H1. Bearish FEG here. And NY session completed the retracement. Stopped at the bag, the breakaway gap. Today price action was lame after the H1 expansion. To the bag, we retraced back inside the range. Nice. Started off under respected EQ. This is previous month's EQ. Previous week's low, left untapped, flipped this gap, but respected this one. Daily. ICT pointed out the VI. He wanted price to retrace. So that made sense. I think we should go lower. My target is still May open price since today's candle closure. Created a daily fair value gap and sell above Monday's high. Yeah. Today, FEG for a Tuesday high of the week will be a textbook week, especially if CPI accelerates the trade. We really don't have to go back. We could just sell. But this will be a pretty profile. You got a flat bottom here and a flat bottom here. Volume imbalance, low resistance liquidity run. And where we sell from is big key. Look at SPX. This looks weaker. We didn't go as high. H1. And we finished, like we closed the day under this gap. That's a sign. And on the daily, price didn't even reach the VI on SPX. And I still like May open price. I guess we barely hit it. This wick could be the key level, 50% of this wick, or that gap as well. Down close day on SPY. pretty sure the CFD did finish green for NASDAQ. Yeah, it's an update, but on QQQ it finished red and a doji. And NVIDIA down day, but it started to retrace in the day. I did engage. We rejected off of this weak opening gap. We were expecting it. I missed this part. Like this stopped me out for the second one. And this happened. I was like, oh, I was right. And came up here. I think price kept going up after that. So I was wrong. I saw the rejection at the old weak opening gap around the horizon. After 3 tries, I stopped. No need to fight with the market. I followed my plan. Good execution. That's what I'm really focused on. What did I do well? I recognized I was wrong. It did not try to force a sale setup all day. Did the framework play out? Nope. I was expecting price to break previous day's low. What did I learn about the pattern narrative of myself? We're doing good implementing the habits of consistency. And what I watch for the marks. No moves. Just double check all of this. And then put this in the Telegram. All right, y'all. Have a good day. Peace.